Good day. Good day. Back into the class, back with investment analysis and portfolio management. And students, we had been talking at length about portfolios, the management, the reasons why we make portfolios, other aspects of portfolios like choices and different aspects that we look at, like what? Like the asset pricing models. The capital asset pricing models was discussed, and we focused on Markowitz's portfolio theory, and on that is what the asset pricing model is built upon. So capital asset pricing model is built up on the Markowitz portfolio theory, and we assume that each investor is talking about diversifying his or her portfolio according to the Markowitz model. So capital asset pricing model focuses on equilibrium relationships between risk and expected return on risky assets. So we looked at length about the factors that are revolving around the capital asset pricing model and the predecessor, the Markowitz portfolio theory, and assumptions that all investors use the same information to generate an efficient frontier, plus they have the same horizon, the same one period horizon for their portfolios, and then they can borrow or lend at risk-free rate of return, plus there are no transaction costs, no personal income taxes, no inflation, and that no single investor can really affect the prices of a stock market, because stock market is too big for a broker, too big for an investor, and no single investor can probably make an impact on the entire stock exchange. It would need some bigger forces to make an impact, and that capital markets are in equilibrium. These were the assumptions of the capital asset pricing theory, the capital asset pricing model, and we are to understand about the borrowing and lending possibilities and the risk-free assets, plus certain to be earned expected returns and a variance of return to zero. That is what we understood by the assumptions, plus the fact that there's no correlation with risky assets. That is what we talked about, and we understood that usually proxied by a treasury bill. These are things that we have to take into account when we are talking about portfolio management and choices, and we are adding a risk-free asset to, and that changes the efficient frontier. These are important. We need to understand default rate risk, market risk. These are the amounts to be received, and these are known with certainty. These are all in relation to borrowing and lending possibilities. Because we're talking about portfolio management, we must understand this in a little bit more detail. So let's talk about borrowing possibilities. And borrowing possibilities would mean that maybe investors no longer restricted to wealth, or maybe the interest paid on borrowed money, which means higher returns sought to cover up costs, and we assume borrowing at risk-free rate of return on risky assets. Also, that risk will increase as the borrowing increases, all because of financial leverage, because more you're exposed to borrowing, obviously you're more exposed to risk factors. Obviously, since you do not have the capacity, you do not have the potential to hold on to scripts, you do not have the capacity to build up a portfolio to buy and hold strategy, chances are, in case there is bad times in the market, you'll panic. And you'll panic because that's money that you use does not belong to you but has just been borrowed, on which you also have to pay a cost. So costs add up to the miseries, costs add up to the costs add up to the panic. So these things will affect your decision-making powers while we're talking about borrowing. Now the new efficient set is what we talked about, which talked about risk-free investing, and borrowing creates a new set of expected return risk possibilities, a variety of possibilities. In addition of risk-free assets, we understand there is change in the efficient set, and the arc to straight line tangent is feasible set with the new environment. Now, the chosen portfolio would depends on the risk-return preference. We need to understand, and we've talked about this before, that there is a possibility that we do not need to take unnecessary risk, because unnecessary risk will necessarily not produce the required results needed. Unnecessary risk will definitely not be taken into task when we're talking about more the risk, more the gain. Sometimes unnecessary risk will be unnecessary. We won't get those sort of returns by taking substantial risks. So it's not a good choice. So what is a portfolio choice then? A more conservative investor would like to park his monies into risk-free lending and will have less borrowing. Also, on the other hand, the more aggressive investor will like to place it in a risk-free lending, and the more borrowing will be occurring. Obviously, the aggressive investor will be more averse to risk than the more conservative investor. Most aggressive investors, I must add here, would use leverage to invest in portfolio theory. Because you're taking more risk, because you're going to be exposed more to the market, you get greater returns, but obviously there is a downside which talks about being able to absorb more risk as well, because you're prone to risk. That's why you're taking aggressive behavior. The most important implications of the capital asset pricing model are that all investors hold the same optimal portfolio of risky assets. The assumptions are that the optimal portfolio is at the highest level of tangency, at the highest point of tangency between risk-free and the efficient frontier. We're talking about tangency in relation to risk-free and the efficient frontier. Also, we need to understand that a market portfolio, or the other word is the portfolio of all risky assets, is the optimal risky portfolio. Why? Because a market would have all the assets included in it, whether they're risky or not. And if you are playing at the level of market risk, you'll be having a generally more risky portfolio. But then what would be the characteristics of market portfolio? And these would be: one, all risky assets must be in portfolio, so it is completely different. And the entire market can be, and includes only systematic risk. Also, all securities included in proportion to their market value. Plus, unobservable but proxied by the S&P, the Standard & Poor's 500, and then it could contain worldwide assets. Whether they're financial assets or real assets is irrelevant, but we can talk about global diversification. We can talk about diversification as far as S&P 500 is concerned, and we're talking about the entire market being in a market portfolio. These are the characteristics of a market portfolio. But other things related to markets and market portfolios are the separation theorem. And we talked about the investors use their preferences. In the separation theorem, the investors will be using their preference reflected in an indifference curve, and we've seen this previously, and they will use their preferences to determine their optimal portfolio. Everybody is looking for the best returns. Separation theorem tells us that the investment decision, which risky portfolio to hold, is separate from the financing decision. Also, there is an allocation between risk-free assets and risky portfolio, separating from choice of a risky portfolio. So the separation theorem focuses on determining the optimal portfolio for each individual and their preferences. The theory or the theorem will then separate the decisions between risky portfolios and the others. All investors in this theorem will understandably be investing in the same portfolio. They'll also be attaining at any given point of time a straight line by either borrowing or lending at the rate risk-free, depending on their preferences. The important thing to understand here is that risky portfolios are not tailored to each individual's taste. Sometimes there will be chances that these portfolios may not be in the liking of each and every individual. Now the question arises, you cannot have a satisfactory level for everybody, so there will be problems with all investors, and then there will be some who will be satisfied with the risky portfolios, Others will maybe show their discomfort. So you'll have to have some sort of acceptability level, because these aren't tailor-made for each and every person's discretionary habit. That is one of the things that we must understand. And when we understand these things, we must have understanding of the security market line. We talked about the capital market line, which was in generics, but we need to understand the security market line in focusing one individual scripts. Now, this capital market line equation only applies to the market equilibrium and efficient portfolios. But the security market line, on the other hand, depicts the trade-off between risk and expected return for individual securities. That is the difference. Under capital asset pricing models, all investors should hold the market portfolio. Also, how does an individual security contribute to the risk of the market portfolio? That is the key and the difference between a security market line and the capital market line. We're talking about generics or macros, and when we're talking about security market lines, we're talking about micros or individual scripts. Also, while talking about security market lines, we must understand that each security's contribution to the risk of the market portfolio is based on betas. This name came up in the last lecture for the first time, and the security market line is responsible for contributing to the risk to the market's portfolio, which is based on a beta. And the equation for expected return for an individual stock should be appearing on your screen right now, and you can have a quick glance on the equation just to refresh you, because we showed this to you in the previous lecture. But since this is about betas, this is about expected returns on individual stocks, it's important for you to refresh your minds and understand the significance of betas. So then what is a beta? A beta is figured as, let's say, 1, and it implies as the risk of the market. It is an equation with the market risk, the entire market risk, and securities which have a beta greater than 1 would be more risky. Betas of securities less than 1 would be less risky than the market. Now we're looking at companies with betas less than 1 as favorable for the portfolios, and avoiding betas with beta level number 1 for the stocks. That had to be avoided. So beta measures systematic risk. All securities should lie on the security market line. Betas measure relative risk. Betas measure the relative risk compared to market portfolio of all stocks, and beta measures volatility that is different from the market. Beta is important for us to understand, because the expected return on the security should be only the return needed to compensate systematic risk. Beta plays an important part in constructing portfolios, because beta helps us eliminate risky shares and look at shares which are more acceptable with betas less than 1. Now, going further and talking about the capital asset pricing models, return beta relationship, we've talked at length about returns and risk. We've talked about risk separately and the kinds of risk. We've talked about returns and what's the risk-return trade-off. Here, it's important for us to understand relationships between betas and return. The required rate of return on an asset is composed of risk-free rates, risk-free premiums, which is the market risk premium adjusted for individual specific securities, and the greater the systematic risk, the greater the required return. A quick glance at the equation will make things clear to you. And once again, the required rate of return will be the risk-free rate of return and the risk premium, which will help matters be cleared in your minds about the return beta relationships, because we are trying to get greater the systematic risk control, because the greater the systematic risk, the greater the required return. Obviously, the required return will increase along with the systematic risk, and that is what we need to understand while we're talking about return and beta relationships, because the required rate of return on an asset is composed of risk-free rates and the risk premium. We must understand, and by now it must be clear to us, that there is a certain amount of risk involved, and you're talking about the stock market. We've got no inhibitions in understanding that we're talking about risk as in capital markets. We must be able to understand the estimation of the security market line. We're focusing on securities, trying to get out of the market in generics and focus on individual specific scripts. So the estimation of the security market lines is important, and the treasury bill rate is used to estimate the risk-free return, and it is important to realize that. Also, expected market return, once again, we've talked it about a number of times. When the word expected comes, it's about uncertainty. When the word expected comes, it's about being unobservable. When we're talking about expected, we're talking about the future, and future is unobservable, and future is not to be taken lightly because we don't know anything about it. So when talking about estimated market return relationships which are unobservable, we estimate it using past market returns. We have to take into account what has been happening in the past, and that will give you an inkling of what lies in the future, and then you're going to be talking about taking an expected value based on previous data. Also, we must understand that estimating individual security betas is difficult, and only company-specific factor is in the capital asset pricing model and requires asset-specific forecast. Now, this is interesting, this is serious, because we are now talking about specifics. We're talking about securities, and we're talking about only company-specific factors in the capital asset pricing model, plus that requires asset-specific forecasting. Now, when we talked about the capital market line, we focused on the entire market. Now, since we're talking about capital asset pricing models, we're talking about the security market line, we must realize that they have to be company-specific, and then estimating individual securities betas, which is difficult. Each and every script has to be calculated, values calculated, and then compared with the beta of the market. First, we must be in a position to get into the act by having the beta of the benchmark. The benchmark here would be the market. Then, if the market has been established as a beta, we would be able to look at companies and then compare them with the beta of the market to find out whether these are risky assets or less risky assets or risk-free assets. Will base on the denominator of 1, which once again will tell you whether it's above or greater than 1 or less than 1. Not to remind you, but nevertheless, companies with betas greater than 1 are more riskier than the market. Companies with betas less than 1 should be considered for investments. While estimating betas, we must look at different models like the market model and the characteristic line. We have to go into the details of the market models and the characteristic line, which would mean that the market model relates the relation and the return on each stock to the return of the entire market. We're comparing, we're talking about relative strengths, we're talking about relative returns, we're talking about relative stabilities of stocks in relationship to the benchmark, which is a beta of the market, which is 1. So assuming all this, we must understand we're looking for best possible options. And the characteristic line is also significant to be talked about because the line fits to total returns for a security and is relevant to the total returns for the market index. Wherever, whenever, however, we're talking about individual securities, we have to talk about it in relative terms. We have to look at the capacity of a stock to be taken into account, to be put into portfolio eventually, but in relationship to its strength with the market. We have got a market. We cannot include the market in the portfolio because if we That's the market risk. We have to play safe. We have to perform better than the market. We have to have betas of companies lesser than 1. We have to have better earning potential capacity bearing stocks in the portfolio to be able to outperform the market and to have the expected rate of return which is required after all the expenses to be occurred, including interest or inflation or the commission charges that take place every time you're buying and selling. Then the question will arise, how accurate are beta estimates? Since we're talking about future, there's no such thing as accuracy. There's no such thing as certainty. All in the air, it's all a good guesstimate, it's all a good estimate, it's all about hitting the estimate right, just trying to figure out the future, which is unobservable based on all the previous data we've collected on the security and the market. But then again, it's just an estimate. The question is, how accurate is the estimate? Betas change. Remember, betas are not constant. Betas will change with the company's situation. Betas are not stationary over time. Betas are not constant. Betas are volatile and will depend on the company's performance. So estimating a beta's future or estimating a future beta, we must understand there may be a difference from the historical data. While we are estimating betas, they may differ from estimates of the historical data provided to us. Also, we would be looking at the representative factors and codes that the total of all marketable assets in the economy and approximated with the stock market index. We have to find benchmark. Betas have to be approximating return on all common stocks. It's not an easy task, but once you get it done, you'll have one of the best, probably one of the better benchmarks in determining where to invest stocks markets in. Betas will help you find a benchmark. Remember, when we're talking about indices, we're talking about the mood of the companies in the index, which was representative of the market. Now, since you know how the market is performing, by the value of the market index, whether it's going up or down compared to yesterday or the previous days, you will have an index-based reference for the market. But what you need is a beta-based market index for evaluating individual stocks in the portfolio. For one, you may have the beta of the market for starters, and then have individual company betas with which you can compare their performances and then find out what's happening. But remember, you have to make periodic assessments, you have to make periodic changes, because beta keeps changing with the company's conditions. There is no one correct number. There is no one correct number of observations and time periods of calculating betas. No one correct number. But the regression calculations of the true alphas and betas from the characteristic line are subject to errors in estimation. It's all about estimates. There can be errors. The regression calculations of alphas and betas from the characteristic line are subject to estimate errors. Portfolio betas more reliable than individual security betas because of the flexibility and the ability to look for whipsaws, volatilities, and any unobserved errors in the data that's been provided can be adjusted. Much easier because you've got an average. You've talked about averages of the portfolio and the market. But if you're being precise, if you're wanting to be perfect, that's rather dicey and might not be as reliable. So portfolio betas are less reliable of individual stocks. Portfolio betas may be more reliable. Because there are a collective of companies there, we are able to understand that betas would give you a generic information about your portfolio in relationship to the market portfolio's betas. A market portfolio beta would be a beta of the entire market. Because you have to compare, and then it is the only way. Remember, we are at the times of talking about assessments. We are at the time of talking about the last possible thing in portfolios, and capital asset pricing model is one of them. So we've got to look and come to a conclusion what sort of things are going to help us in building up a better portfolio, better than the ones available in the market. So if you're looking at efficient returns, you've got to look at a better portfolio. Remember, there is no one script that can overpower the portfolio, provided there is a proportional calculation on what amounts of stocks to be put into the portfolio based on their performances, plus the fact that these portfolios are built up of individual stocks, and once again, it's going to be difficult for individual stocks to outdo the market in the portfolio, but they'll generally be in line with the portfolio, and no one stock can change the condition of a portfolio. Why? Because of proportionate inductions of shares in the portfolio. Similarly, I mentioned before that no individual can outperform the market for a very long time. It'll be in short spurts, yes, but in the longer run, the market, the portfolios will control individuals. Capital asset pricing was all about that. Portfolio theory is Markowitz's model. What about the arbitrage pricing theory, APT as they're commonly known? The arbitrage pricing theory is also be taken into consideration, and this is based on the law of one price. It's based on a single price. It's based on the law of a single price of a product. The arbitrage pricing theory is about two otherwise identical assets that cannot sell at different prices. The same asset, but cannot be sold at the same price. Has to be sold at different prices, but cannot be sold at different prices. We're talking about shares that can be dealt with at different places in maybe the same price. So these are two otherwise identical assets. Now, equilibrium prices are just to eliminate all arbitrage opportunities. Since there is a balance, there's no discrepancy in prices, then it rules out any advantage that you might be able to take of price discrepancies between the two different places of the same product. Unlike capital asset pricing models, the arbitrage pricing theory does not assume. The focus is on does not. These are two different things. Single period investment horizon, absence of personal taxes, riskless borrowing or lending, mean variance decisions is all that's to be talked about. So it is arbitrage pricing theory is all about arbitrage. Arbitrage would basically mean the advantage that one would be able to do while sitting in one place, taking advantage of price differentiations in one place of the same asset in a different place. So these are two otherwise identical assets that cannot sell at different prices, and this is the APT, which is based on the law of one price. But the advantage of going back to when we were talking about the efficient market hypothesis and taking advantage of the weak forms of the markets, and talking about the information flows coming into consideration, we must understand that this is important because you are able to hedge your risk, maximize your profits through arbitrage. The factors that are to be looked at in the arbitrage pricing theory are that the assumptions that returns generated by a factor model. So APT assumes returns generated by a factor model. The characteristics of the factor are that each risk must have a pervasive influence on stock returns. It is significant to understand this, and we must look at the risk factors. The risk factors must influence expected return and have non-zero prices. Also, that risk factors must be unpredictable to the market. The market itself is actually unpredictable, so there's no problem in understanding that the risk factors must be unpredictable. Obviously, you cannot talk about risk uncertainty. We're talking about uncertainties. And remember, risk. Once again, the future is unavoidable. Risk, once again, is unavoidable. Future has to be faced and managed. Risk has to be managed in the best possible way. So risk and future can be come across in a more mature way if you are ready to manage risk and face the future. They're all challenges. Capital markets is all about uncertainty. Predictability is not the name of the game. It's all unpredictable. And APT assumes returns generated by a factor model. And the characteristics that included that each must have a pervasive influence on the returns of the stock. Whatever we're doing in the stock market is to be revolving around capital gains, returns, interest, dividends, and in the future, invested today, these have to be taken in account, and that is why we must understand that risk is one factor. Risk factors must be able to influence expected returns and have a non-zero price. These are the aspects or the factors that the arbitrage pricing theory assumes, has the assumptions of the APT are based on these factors. Suddenly it is incurred that there are other issues in the arbitrage pricing model, which can be better understood if you look at the most important ones of them are the deviations. The deviations of the factors from the expected values. Because we're talking about expectations, we're talking about the future, there can be deviations from the mean, there can be deviations from expected values, and we talked that the actual values, the actual returns are always different than expected values and expected return. The expected return risk relationship for arbitrage pricing theory may be seen on your screens in the equations that you can look at, which will include risk premium for the risk premium factor, risk premium factor 2, and risk premium for factor n. Number of risks from 2, 3, 4, 5, 6 to an n number of periods. These are the things that you've got to look at when you're looking at your screen in the equation. But these are the equations that will help you understand the APT model, because these are to be understood as the most important of them being deviations from the mean. It is the deviation that confuses expected cash flows, and you are unable to then calculate your future plans. These may just be the problems with the arbitrage pricing theory. Factors are not well specific. The factors are not well specified. To implement the arbitrage pricing model, there is a need for the factors that account for differences among different security returns. Also, the capital asset pricing model identifies market portfolio as a single factor. Arbitrage pricing theory is about individual scripts. Capital asset pricing model identifies the market portfolio as a single factor. It looks at the market or the market portfolio as a single entity. It may be a mutual fund, it may be a unit of different products, but it will consider for all practical purposes the entire return or the expected return will be calculated on the entire portfolio, the market portfolio, instead of individual scripts and then totaled up and told to you. So the arbitrage pricing theory will focus on individual scripts. The portfolio theory of the capital asset market model is a bit different and focuses the entire market and takes it as a single unit. Neither the capital asset pricing model nor the arbitrage pricing theory has been proven superior. None of them has been. There has been no decision what to look at as the best alternative. There has no work been done to prove that the capital asset pricing model is better than APT, or whether the arbitrage pricing theory is better than the capital asset pricing model. Why? Because I have figured out that both rely on the future, both rely on unobservable expectations. All theories, all models are based on unobserved assumptions. All models, all theory take into account the historical data to find out and predict the future outcome. It's like reading the lines on your palms in finding out your future. A lot of people, study the palms to find out what lies in the future, but This is something very unobservable. And the expectations, once again, may be different from your expectations, which actually do occur eventually. So unobservable expectations are the reason that we have been unable to understand which model to follow, whether it's the arbitrage pricing theory or it is the capital asset pricing model. They may be taken independently and individually or in combination of two, but to be used for a better decision on portfolio investments. All this has been done to build up a portfolio. All this has been done to see what fits best into the portfolio. We had talked about not putting all your eggs in one basket. Then we talked about putting all your eggs in one basket. The difference between the two was that you were scared of putting all your eggs in one basket because the basket falls, all your eggs falls and break up, portfolio goes bad, all your investments go bad. But then you can put all your eggs in one basket, put all your monies in a portfolio, and then watch the portfolio, which means you manage the portfolio, which means we're talking about portfolio management once again. We talked about investment analysis. We need to talk about portfolio management more and more. We talked about theories, decision factors, and the scope of the portfolio. So portfolio management involves decisions that must be made by every investor, whether an active investor or passive investment is to be desired. The approach is irrelevant. Also, there are relationships between various investment alternatives that must be considered if an investment is to hold an optimal portfolio. The word you must focus is on optimum, the best possible return considering risk. Risk, once again, is there. We're looking for best alternatives to avoid risk, to manage risk, and come up with an optimal return, which would mean an optimal portfolio. So, portfolio management would require decisions that have to be taken by any investor, and they have to look at it seriously, whether it's active management of the portfolio or passive management of the portfolio. But the approach that has to be followed is to find out relationships between various investment alternatives that have to be considered if you need to get hold of a portfolio which is ideal or which is optimal and which is maybe giving you best returns for your investments. This is important for us to understand. Another thing that we must understand is that portfolio management has to be looked at as a process. Now, when we're talking about portfolio management as a process, whether it's strategic management process, whether it's strategic investment decision process, or it's strategic portfolio management process, we must understand that there is a definite structure that everyone can follow. We must also understand that the process integrates a set of activities in a logical, in orderly manner. We're not talking about randomness, we're talking about a non-random, precision, systematic, orderly manner in which you manage portfolios and get the optimal results from managing an optimal portfolio, which would be continuous and systematic. We're talking about a regime. We're talking about systematic alternatives to looking at portfolios really in a thoroughly polished way where you have continuous and systematic processes which encompasses all portfolio investments. That would be a structured process. That would mean anyone can execute decisions for an investment. When you have procedures, when you have parameters designed, when you have defined boundaries where you're going to play the game, anybody can make a decision for you once you've set the rules for the game. It's not about ifs and buts. It's not about whims. It's not about personal bias. It's not about personal preferences. Once you set out rules, once you've set out the principles on which the portfolio has to be established and designed, anybody can manage the portfolio. You have to decide what proportion of the stocks have to be put into the portfolio, and then the execution of the decisions can be done by anybody on your behalf. But the process has to be a definite structure that has to be followed, and there are a number of set activities that have to look at while we're talking about the process, plus it has to be continuous. You manage a portfolio. You just don't put in money into a portfolio and put it in the attic. You have to manage it. We're not talking about active management. We're not talking about passive management. We're talking about continuous, systematic watching the portfolio, and then that would encompass all portfolio investments. And then you look at the betas, look at the net asset values of your portfolio. Unlike the earning per shares of an individual script, which you'll do, however, when we're talking about the entire portfolio, but when talking about portfolio management, we're talking about net asset values to be looked out as the result of the entire stocks into the portfolio, because we're looking at portfolios as a single unit. A single unit that is diversified, and you have diversified it. Why? Because you've diversified it to manage risk. So we must understand the objectives. The objectives have to be looked at. The constraints in the process or the management of the portfolio have to be looked at, and then the preferences have to be identified. You identify objectives plus constraints, and then what are the preferences, which means that it would lead to explicit investment policies. Explicit investment policies would then dictate what sort of investments you need to make into what sort of portfolio management. Strategies developed and implemented. There are strategies that have to be developed, and there are strategies that have to be implemented. What strategy is planned, whatever strategy is formulated, has to be developed and then implemented and then evaluated. It is the same strategic management process as in the subject of strategic management. This is about portfolio management. But the strategies are the same. Market conditions, asset mix, and investor circumstances are monitored. Once again, market conditions are paramount. Political conditions are paramount. Sovereign conditions are paramount. Market risks are to be looked. Inflation risks have to be monitored. Foreign currency risks have to be seen to. These are things that you have to take into account, and then portfolio adjustments are made. When you're looking at all these processes, we're talking about looking at the conditions. Macro conditions, environmental conditions, systematic and non-systematic risk, diversifiable or non-diversifiable risk. We have to look at all these things to be able to understand what sort of portfolio management has to give what sort of optimal result. While doing that, we talked that objectives, constraints, and preferences have to be identified. We have to look at the precision, explicit, definite management investment policies. To do all that, we must understand that there has to be a difference between an individual and an institutional investor. We look at institutions as a single investor, though. Institutionals come in not as a gang, but come in as individual investors, only they're much bigger. If you look at individual investors and you look at individual and institutional investors, you look that the institutional investors maintain relatively constant profile over time because they can afford to do that. On the other hand, the life stage matters for an individual. Whether he is young, middle-aged, a senior citizen will make an impact on the relative strength of the institutional investor, because they're going to have a range of investors. We're talking about individual investors, they have to look what sort of a risk and time horizon they're looking at. Its age is going to be paramount in making a decision. In institutional investors, we also look at aspects that they have to see the legal and regulatory constraint. On the other hand, in an individual investor is more focused on risk, defined as what? Simply put, layman's term, losing the money, losing the shirt off your back, getting worried of instead of turning a prince from a pauper, it's the other way around, you turn into a pauper from a prince. These are the holes in the pockets that you have to look at being an individual investor. As an institutional investor, you have well-defined and effective policy, which is very, very critical. More about rules and regulations in institutions, but if it comes to individual investors, they're more focused on personalities, the traits, the behavioral pattern of an investor, his perception about the stock market, whether he's an optimist or a pessimist. What are the goals? For an individual investor, goals are important. The results of his investments are important. For an individual investor, it's important to look at the tax management, one of the integral parts of making any decision. For an individual, there are more constraints than compared to an institutional investor. Institutional investor can bail out himself by waiting patiently. An individual, on the other hand, will maybe panic, will have more costs to look at, like taxes, more efforts, more commissions, and then about his own individual characteristic. It will also depend on his age. And the funds available to him may not be endless, infinite, comparatively to the institution. Institutions have larger sums of money, which help them manage, keep their heads above the water. But for an individual investor, it becomes a doom and gloom situation when things go bad in the stock market. The primary reason for establishing a long-term investment policy for institutional investors is very, very significant. Because we're talking about long-term. We're talking about investments for the long-term horizon. We're not talking about day trading and market trading. We're not talking about being a jobber. We're talking about long-period returns. So this sort of application for an institutional investor prevents arbitrary revisions of a soundly designed investment policy, because homework has been done, principles have been laid, decisions have been taken, precise, explicit constraints are there, you follow the rules. It helps portfolio managers to plan and execute on a long-term basis. We're not talking about volatility of the short term. All these spikes are ignored, which are very significant for an individual investor. He has a heart attack every time there is a bad day in the market. For an institutional investor, that's not a problem. Which means that short-term pressures, short-term panics, short-term ups and downs, short-term recessions are really well by an institutional investor. Institutional investors have more shock absorbers than an individual investor. Individual investors panic quickly. Individual investors do not have limitless funds available to them compared to institutional investors. Institutional investors have got the capacity to weather out the storm. Individual investors will not have that sort of stamina and courage and resilience to, outdo the bad times, the recessions, or the uncertainties of a market. It is a case of investing for the long term. It is a case of investing for better returns. It is a case for talking about the feel of the market, the perception of the market, the results of the market, as seen by an individual's eye and as seen from an institutional investor's eyes. The institutional investor is not responsible for one person. He is responsible for the image of the institution and is also responsible for the monies put in by the investor. So he has got a greater set of responsibility. The individual investor, on the other hand, is focused just on his personal investments and maybe has assumptions about losing money more seriously than the portfolio manager, because he's got flexibility from time, he's got flexibility because of the funds available to him, and then he's got flexibility on the basic precision decision of having a portfolio. It is very difficult for an individual to manage a portfolio with the sums involved, but an institution can really diversify his risk by managing it through optimal decision-making process in putting in the best fits into the portfolio and the best proportion in which to fit in the portfolio script, so that he may have a better result of getting a better return compared to the market, maybe based on a beta, maybe based on other assumptions or future forecastings, but will definitely be able to outdo the individual investor. Then he would individually talk about being an institutional investor. Now, the important thing here to understand is, while we're talking about portfolio management, is that we're doing that for a certain purpose. The goal is there, the objective is there. All we need to do is to understand how to get to the goal or the objective. While we're talking about management by objective, we have to have goals defined. What is going to be the expected return? What are you expecting as means of getting a return on your investment? And then only you'll be able to manage your portfolio. Whether you manage it passively or manage it actively is another thing, but what has to be looked at to manage it with professionalism. When you're talking about professionalism and managing a portfolio, you have to talk a little bit about how to formulate investment policies. But we have to do that at a later stage, because we can't fit in all the topics in one lecture. We'll talk about investments and the policies and a little bit ahead of portfolio management in the next lecture. Until then, this is me talking to you. Thank you very much. Have a nice day.